Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She worked on Wall Street and at the Dallas Federal Reserve. She's the author of Fed Up. I think she's one of the best writers in the entire financial industry. She's a full-time columnist for Bloomberg View, and she writes a paid newsletter for Money Strong. Danielle DiMartino Booth, thank you for joining me again.
Great to be back with you, Jason.
Now, Danielle, I want to get your impressions of Jay Powell. Do you think he's more like Paul Volcker or your former boss, Richard Fisher, or do you think he's going to be a continuation then of the Alan Greenspan, Ben Bernanke, Janet Yellen line?
No, say it isn't so. I'm so excited to report to you that Jay Powell is much more in the fashion of Paul Volcker and Richard Fisher both. He's a pragmatist. He's not a PhD in economics. He actually knows how to speak English, which I think he's already represented several times in the few public appearances he's made since coming onto the Fed. And I think, though, he has an appreciation for the work that many of the brilliant economists do, his predecessors, as you just said, Bernanke and Yellen, he also understands how they apply to the real world. And I think that makes him much more a new leader, but in the mold of great pragmatic leaders such as Paul Volcker and Richard Fisher.
Now, the Fed decided not to raise interest rates last week. Do you think that was because they were worried that the dollar was getting too strong? And they did talk about inflation expectations increasing a little bit in the transcripts released, but they didn't seem too worried. So do you think the Fed is worried about inflation increasing?
Oh, I do. You know, we're coming up on the next release of the minutes, and because there was no press conference that followed this May FOMC report, I'll be very interested to see how heated the discussion was among the FOMC members. If you look back to the release of the prior minutes from the January meeting, it was the first time since 2001 record keeping began that no one member on the Federal Open Market Committee expressed concerns about inflation rising. And we actually saw that come out in the May statement because he made the verbiage that much more strong as reference to inflation heating up. But again, as he said in his first press conference, he is not about to drop a bomb on the stock market. That's not his style. He understands markets. He's not trying to be a disruptor. But I would not put it past Jay Powell to announce at a future FOMC meeting that he is going to be implementing a policy of press conferences after every single FOMC meeting, such as to make them all, quote unquote, live meetings, so to speak.
That's interesting that the Fed didn't bring up inflation that much, because when I listen to experts like you and a lot of other people I read on Wall Street, there is a lot of evidence that inflation in the real economy, whether the producer price index or core inflation, those things are starting to become apparent now.
Oh, absolutely. In fact, the last man standing, the last of the Mohicans, is the Fed's antiquated and arbitrary core PCE measure, which is the only one that is still at 1.9%, technically below the Fed's 2% target. But if you look at headline PCE, core CPI, CPI, PPI, even wage inflation, all of the other inflation metrics, none of which actually truly capture asset price increases, but none of the other potential candidates are running below the Fed's 2% target. It is ridiculous that they continue to rely on a metric that is so very flawed in order to give them cover to keep interest rates at artificially low levels, Jason.
And you think that Jay Powell is going to actually talk to business owners more compared to past Fed chairmen who were more focused on models?
Oh, without a doubt. He has a tremendous network of CEOs. This is the man who started the Industrials Group when he was at the Carlyle all those years ago. There's no way in the world that in the years that have since followed that Jay Powell has not actually expanded his network of CEOs, and they have all told him, I promise you, that they are getting squeezed by margins. We're hearing it. It started with Caterpillar. Actually, it started with General Mills reporting before even Caterpillar. But Caterpillar was the one company that basically said, we have hit the peak. Our margins are getting squeezed because our input costs are rising. We're seeing it echoed. We've heard it echoed throughout the earnings season that input costs are choking off profit margins. It's a very real thing, and Jay Powell understands it, and he will take that much more strongly than he will a broken inflation metric created by models.
The input costs rising, wages are not really going up. The economy is creating jobs, but in my view of the jobs numbers, it looks like mostly part-time jobs. So that, to me, Danielle, looks like stagflation.
The possibility of stagflation is definitely out there. There are two races being run at this time in the economy. One of them is that if you look at, in fact, I'm writing about this for my next Bloomberg column, but one of them is if you look at goods manufacturing wage gains, they have taken off. If you're anybody in this country with a skill of any sort, you are naming your salary, you're naming your income, you have ultimate pricing power in the job market, which is very unique compared to the stagnant wage environment that the country's been mired in for years. The problem is there's not enough of them. There are not enough skilled workers in this country, so the labor market in and of itself is so bifurcated at the moment. You have the death of brick and mortar that is slowly putting people out to pasture, and they don't have the ability to just jump in and become a welder the next day. And so in a lot of cases, to your point, yes, they'll take on part-time employment rather than do nothing, but that certainly is not ideal. But again, if you want to think about the labor market today, it's stronger than it's ever been, and yet it's also weaker. But it depends on which side of the barbell that you're on. If you've got the skills that are needed right now, then you can name your price. If you don't, good luck.
Austrian school economists would call this misallocation of resources. So yes, people are having jobs, but the economy is not working the right way. I think a lot of it's because of central planning. A lot of it's because of the nonsense that a lot of these 5 or 6 major central banks have done since the 2008 financial crisis.
Yeah, Jason, I could not agree more. I think some of it also goes to the teachers' unions of the world and the fact that that as a country we strayed away from educating our children in the fields that are really that pay today, that pay to this day, and we stigmatized vocational training, which, by the way, is something that Germany never did. And right now, Germany has a much more balanced workforce as a result, and they don't have this problem with millennials making too little money, because it was never shameful if you were in Germany to not go get a liberal arts degree that wouldn't pay you.
There's also a anti-capitalism, anti-profit, anti-business bias in government schools at younger ages when kids are being taught in schools, and then even when they go to the university. So I think that's a problem, because kids should learn how to read financial statements when they're teenagers, and around that age they should learn basic personal finance before they leave high school. They should even be required maybe to take some entrepreneurship classes, just so that way if they're going to get into business at some point they have like some type of background. But none of those things are required. So I think the school system as it's currently built for government federal school system is not teaching the kids the stuff they need to succeed in the real economy.
Yeah, I would agree with that. I think that there is going to be a rationalization of the entire educational system in this country, and I don't think that I look at education, especially higher education, through the prism of kind of a typical capitalist, a business person. It is time for some serious consolidation and weaving out, culling out the weakest players.
Well, Danielle, if there was real capitalism and free markets in that educational system, wouldn't you be getting a higher quality product at a lower price? And that's not happening because there's perpetual tuition hikes at these universities. And I did a study. I looked up some studies on this because I'm trying to raise money for an educational technology company that I have. I have a business plan. And the cost of textbooks in the last 40 or 50 years, the inflation in textbook prices has gone up 1,000%.
Oh, it's remarkable and it's criminal. I actually spoke to an economics professor whose textbook has been in the classroom for the better part of 20 years, and he said to me, the changes, the tweaks that I have done to my textbook over the years do not in any way begin to justify how much the cost of that book has gone up.
Yeah, it's a racket, and it's like what George Carlin says, it's a racket and you're not part of it.
Very well put.
Yeah, because I mean, every year they raise the price, what, $50 or $100, and then you go and resell the book, and you're lucky if you try to sell it back to the school bookstore if you get like a fraction of that cost. I think now there's secondary markets, but I think the schools are going after those people as, evil black marketeers.
I had not heard that one, which you just realized with my reaction.
Yeah, there's Chegg and a couple others, so those are going to probably be banned at some point.
As I would say on Twitter right now, #asinine for going after them.
Or #facepalm. So the New York Times and other mainstream financial writers think it's likely that the Federal Reserve will do a rate hike in June. Do you think that's the case, or do you think there's other factors in like the dollar index and that the dollar index with the dollar strengthening, having a rally lately, could potentially delay the next Fed rate hike?
Well, the dollar rally has stalled a bit, which should take the heat off of the emerging markets. But Jay Powell made a speech overseas just a few days ago in which he said, I think the emerging markets are much better equipped to withstand any kind of appreciation in the dollar. And again, he is talking to CEOs of corporations who are telling him it really doesn't matter what the inflation that your models produce tell you inflation is. What matters is that actual prices are rising and that inflation is real. I think June is as much baked into the markets as anything could ever be. I think the other questions going forward are what the potentials for September or December hold, again, if press conferences are not implemented after every FOMC meeting.
So let's talk about quantitative tightening now. I think, that's a very Fed speak term. It should just be called balance sheet reduction. The Fed is planning on ramping things up with balance sheet reduction to $50 billion per month in asset sales starting in October of this year. That would be an annualized run rate of a $600 billion sell-off in their balance sheet. If the Federal Reserve is hiking rates, continues to hike rates, and start selling off a massive increase in their balance sheet, they've only sold off, I believe, a little over $100 billion so far in the last year, according to the St. Louis Fed when I looked at the website a couple days ago. Do you think eventually something with those combination of interest rate increases and balance sheet reduction that's going to eventually break something then in either credit markets in the real economy or prick one of these asset bubbles that we have?
Well, I think that actually the latest figures that I saw, I believe, were 128 billion, and at some point the cumulative effect of the flows, if you will. I'm not a stock person. I'm a flow person. I believe that what matters is money coming in and out of these markets. That were, if it's coming in, then it's artificially propping up prices. If it's coming out, then it's putting downward pressure on prices. I like to use some of the Fed's math, believe it or not. And many moons ago, they quantified that for every $200 billion or so, give or take a billion, of quantitative easing, that it translated into a quarter point rate ease, so reducing interest rates by a quarter of a percentage point. So if you flip that argument on its head, if you just flip that math and look at the mirror image of it, that means that for every $200 billion or so of quantitative tightening, that we get the equivalent of 125 basis point rate hike. So that means that by the end of this year, if the Fed truly pushes through with 4 rate hikes, which I think is a big if, but if they do, and the balance sheet runoff is $440 some odd billion, then we will get the equivalent of 6 rate hikes in 2018, which I do think will get the attention of investors. I do think that it has the potential to do harm to a lot of these overblown credit markets. The problem is the rest of the world is beginning to slow, and we don't know whether or not the European Central Bank is going to get a set of very bad nerves and renege on its commitment to carry through with the tapering of its own QE program by year end. If that's the case, then we will have gone from $2 trillion to $1 trillion of QE on a per annum basis by the end of this year. And again, that is significant enough to get markets' attention.
So even if the QE slows down, I don't really see these 5 or 6 major central banks, and the European Central Bank and the Bank of Japan now have larger balance sheets than the Federal Reserve, because the Federal Reserve hasn't really expanded their balance sheet since, according to that chart that you put out in your Zero Hedge article last week, I think October of 2014, their balance sheet hasn't expanded since then. I don't really see them being able to meaningfully reduce their balance sheets, by hundreds of billions of dollars in a short amount of time. I mean, maybe over the long term, they could potentially do that, but I think we're going to probably have another global financial crisis in the next couple of years because there's just so many credit bubbles at this point. I could name over a couple dozen different credit bubbles that have blown up. I have a list here. So we have the shale oil bubble. Some of these shale companies are not generating free cash flow. They're hedged out. They've raised a lot of junk debt. The guy who put on the big short trade, the banker from Deutsche Bank, he just came out recently and he said that the biggest bubble he sees is the corporate bond bubble. So if the interest rate, the Fed wants to, you can chime in if you think I'm wrong about this, Danielle, but I think the Fed wants the yield curve to steepen, right? That's ideally what they want. But it seems that the market right now with the interest rates, the yield curve is flattening. So if the yield curve flattens when the Federal Reserve is trying to raise rates, what's that going to mean for these credit markets and asset markets?
Well, you just asked a mathematical question. If the yield curve flattens as the Fed is raising short-term interest rates, then the Fed is going to invert the yield curve. So that is the main risk, and inverted yield curves have never failed to predict recession, namely because there is nothing that's more effective in igniting fear among investors than an inverted yield curve.
And so you don't agree then with those research reports that say that once the yield curve goes inverted, it's a very high probability that the government statistics will say that it's a recession?
No, I'm saying exactly that. I'm saying that because inverted yield curves have never failed to precede recession, that if the Fed does continue to raise rates into a flattening yield curve, that it will invert the curve and ignite fear among investors.
Yeah. So let's transition now to China. The People's Bank of China has actually done an enormous amount of credit growth in the last 10 years. Do you think then that China is going to have like an AIG or Bear Stearns type of moment with this Anbang and HNA, the problems that they're there? Or do you think that they're just going to print up the money and no one's going to complain over there and it's just going to be like undercover bailouts and their media won't even cover it over there?
I just don't know. I don't know what life the Chinese economy is on. If a cat has 9 lives, I don't know if it's on its sixth death, seventh death, 8th. I just don't know. I don't know. I cannot tell you about the black box of the Chinese credit market because all we know is that it is massive and that every time there is any kind of disruption, that the government somehow, some way manages with its pile of foreign reserves. Remember, he who has cash rules. That they always manage to create a new debt market to bandage over the damage to the last. So again, how many dead cat bounces will the Chinese bond market have? I don't know that anybody, you can all say that there's a hell of a lot of speculation in that market and that it should have long gone, have blown up to kingdom come. But nobody with any credibility can tell you what that catalyst is going to be.
Yeah, Kyle Bass has been betting that the RMB will devalue for a couple of years now by at least 15%, and he's been wrong for a couple of years, and he's a really smart guy. So I think, I agree with a lot of his fundamental analysis of the People's Bank of China balance sheet and the Chinese economy, but he's obviously been wrong on the timing. So they've just been really good at delaying the timing out. The Chinese, their trade surplus, Danielle, it could drastically reduce if President Trump is serious about this trade war escalation with $150 billion or more in tariffs. What's your view on this and looking back through financial history? Because it seems that President Trump is going to claim no matter what happens that the U.S. is going to win a trade war with China. But I think pretty much all of us are going to get some type of we're going to be some type of collateral damage if this thing does escalate.
Well, remember, we just spoke extensively about inflation. the collateral damage is already being done here in the United States because companies have been panic buying on the threat of tariffs being implemented. Companies are actually exacerbating the problem because they're trying to stock up when prices are relatively reasonable so that they don't have to pay higher prices in the future, but it's having a totally adverse backlash effect. It is actually pushing up prices, which is what happens every single time you have panic buying. So I think when it comes to China, that China thinks that these tariffs are a joke because so much of what comes in and out of their country is not exported directly to the United States. So they really must just be sitting back and chuckling at what we're doing. We could hurt some of our allies, and there is irony in that.
That's interesting. Yeah, I know with looking back through history of trade wars that there's always collateral damage. So when a president or a government tries to go after a specific company or specific industry, it normally never works the way that the government agency thought it was going to go. And so normally it ends up hurting a lot of different people. I think China really does rely, though, on their trade surplus. So if the U.S. with some of the U.S. could definitely hurt China, but China has announced some pretty serious retaliatory tariffs that could go into effect. I have a good amount of American farmers who listen to my podcast, and they are, small business owners, and they are legitimately worried that if China taxes like soybeans, walnuts, or pork and puts large tariffs on those, that all their margins, their profit margins, are going to be totally erased.
Oh, look, I'm not saying that there's not going to be massive collateral damage. I'm saying it's not going to happen in China. I completely understand what the middle of the country and the reasons for their anxieties are very, very real.
So let's transition to a couple other subjects that you write a lot about in your newsletter. So you write about the commercial real estate market and also retail and restaurants. So this seems to me like this is a symbiotic relationship. So if retail and restaurants don't do well, that's going to continue to put even more pressure on commercial real estate. You add in interest rate increases going up, and the holders of the commercial real estate, especially if they're using mortgages and rent mortgages that with leverage, then they're not going to necessarily be able to pass on higher rent increases to every single tenant. That seems like that's an accident waiting to happen.
I think it is. I'm not so sure that people who study the industry have done enough to examine the commercial real estate industry in a holistic fashion. You can't just look at office space and the amount of inventory in office buildings or in hotels or in multifamily or in retail in a silo. You have to, if you consider where a lot of the dying malls are, that's really prime real estate. And you have to look at it as such, that if these malls if there's a ceiling, if there's a limit to how many of these malls, for example, can be repurposed into bowling alleys, then there's going to be a large amount of well-positioned land that comes on the market on the heels of a tremendous amount of construction in a lot of these sectors. So again, when you're looking at inventory, when you're looking at oversupply in the commercial real estate market, you cannot look at it on a sector-by-sector basis because of the revolutionary changes that the retail sector is undergoing right now. And again, to your words exactly, this is an accident waiting to happen.
Yeah, I mean, there's a lot of different factors that seem really bad for bricks and mortar retail. So you have the consumer who just doesn't have the discretionary income because they don't have the full-time jobs. You have the Amazon effect and all the other online shopping that's starting to eat into a lot of people going to malls. People may still go to malls to look at things, but then they'll go on their phone, they'll go back home on the internet, and they'll try to price shop to save money. So you have all these factors here. And so the old retail business is just not working. I mean, look at all the bankruptcies we've had for a lot of these famous retail brands.
Oh, absolutely. I mean, it's funny because if you listen to the conventional wisdom, they'll tell you that what we need to do is just net out. We need to net out the Toys R Us effect because that was just one thing. Well, guess what? I'm driving down the highway. I live in Dallas. I live in a central part of Dallas, and I'm driving down the highway, and I look to my right at, again, prime real estate that is across the street from a very successful A mall type, as opposed to a B or C property. And again, this is very good real estate, but you have a massive Toys R Us, Babies R Us that is empty right next to a massive empty Sports Authority. At some point, you have to be very careful about trying to say this is a one-off situation, especially when it comes to bricks and mortar.
If this was the Washington, D.C. metro area, Danielle, they'd knock both of those buildings down in like a year or two. They'd flatten out the land, and they'd put in just like 10 or 20 floors of high-end condominiums, of apartments and condominiums to buy.
Because they don't understand that there's too many of those as well, unless we're all going to be working for millions of dollars each and every American, such that we could all afford those high-end condominiums.
I think the Washington, D.C. metro area has turned into worse than what Miami was in like 2005 to 2007. So I think, there was really no recession around here, even in 2008 and 9. I mean, this area was under. I live right outside, 20 minutes outside of D.C., and this area was basically this area is a bubble in and of itself, and it was insulated from the rest of the crash, basically. And in the last couple of years, I mean, they've just been building like crazy. They've been knocking down 1 or 2 story commercial buildings as fast as they can and building up high-end luxury condos, and they've been selling those things out, and they just keep building out very expensive single-family homes further and further away from Washington, D.C.
Hey, that's the wave of the future until the future becomes the past.
So for the next couple predictions then for the rest of 2018, if you're going to talk about some themes then for markets for the rest of 2018 or the next year or so, what would you say would be some of the main themes that you're pretty confident, high probability? More asset price volatility, central banks maybe trying to reduce their balance sheet and then reversing course. What do you think then are going to be some of the main things that people should pay attention to?
Well, I think that there is something that is actually seminal going on with our Federal Reserve. I'm paying more and more attention to it. The term inflation targeting or a range, a targeted range for inflation, to me speaks to the future of how the Fed is going to approach the next time that markets get in trouble. Is they're going to they're giving themselves more leeway in the future to keep rates lower for even longer. I hope I'm wrong, but by rolling out constant propaganda and communications, we're talking about every single district bank president and everybody on the Federal Reserve Board has come out in some way, shape, or form and advocated for inflation rather than trying to shoot for a 2% target, to, let's say, have a range of between 1.5% and 2.5%. Well, again, maybe I have PTSD from being on the inside of the Fed for too many years, but that tells me that they're trying to give themselves much more flexibility the next time that we go into recession to keep rates lower for even longer, given the fact that we know it's taken them so long to even hit the 2% target based on the wrong inflation metrics. So I would certainly be watching that. I would be watching for the accumulation, as we were just speaking about, of quantitative tightening and seeing truly how global it goes. Because QE mattered on a global basis. Investors viewed it as being fungible. As long as somebody's checkbook was open, things were great. By the very same token, QT, quantitative tightening, will also matter on a global basis going forward. So I'll be watching for what the Europeans do, whether or not the Bank of Japan allows continued inadvertent tapering of its own quantitative easing program. And finally, I'll be watching the credit markets like a hawk.
Now, a good amount of these academics, these Keynesian academics, whether it's Ken Rogoff from Harvard or Lawrence Summers, they've talked about negative interest rates as a penalty still. They're still talking about it. And Ken Rogoff is even talking about, cashless society and starting to ban $100 bills and other cash. So do you think the Fed, maybe with this blockchain technology and Bitcoin becoming popular is actually serious about, I don't know, testing something called a Fed coin in the next couple of years, because the technology is now available. We have digital dollars in our bank accounts, but we still have the freedom right now to go to an ATM, and pull out cash. But do you think ultimately there's at least a portion of academics and actual people in the actual central banks who want to go cashless, who want to force people into, tracking and taxing every transaction with a government cryptocurrency?
Well, I would caution you because Jay Powell and Randy Quarles both have already publicly spoken about FedCoin. The governments of Great Britain, they've also come out, as well as the Austrians, I believe. And you have to understand that FedCoin is something that can and will need to be implemented, because for a national security purpose, if China, Venezuela, and the Russians all roll out with their own. But as far as control goes, this is not Ken Rogoff's Fed, I'm happy to report. And,
God, yeah.
yes, and both Randy Quarles and Jay Powell have publicly stated that it will not be on their watch that any kind of Fed coin transaction would be any less anonymous than a regular cash transaction. They would want for any kind of a crypto exchange, any kind of a transaction to be as anonymous as one where you and I see each other and you sell me a widget for a $100 bill and I hand you the widget and nobody knows who was behind that transaction. So again, this is yet one more area of gratification on my part that it's Jay Powell running the Federal Reserve, because he staunchly opposes tracking people's purchases.
That's good. So we may have a temporary reprieve, but the technology has the ability now, because there's articles that falsely claim that Bitcoin is anonymous. It's actually not anonymous. So every single transaction, you can look up the IP address and which IP address bought the coin and which one sold it. So it's all there permanently on a ledger. So if a government, I'm not saying the U.S. government wants to do this immediately, but maybe it's China, because China just hired People's Bank. They just hired blockchain programmers to work on some type of China coin, and they're doing like some type of social credit score now. So if you speak out against the government, you can get banned from flying on a plane or riding on one of their trains. And they just came out in the last week. They want to implement an even more Orwellian like social credit score in the next couple of years too, with video cameras and stuff. So if you're caught saying something about the government, you get a huge penalty score on your credit score. But the ability though with this blockchain technology, I mean, the technology is there where they could track and tax every transaction. So if you did buy something from me for $100, there would be like a 15% VAT tax on it if they wanted to. And then they could track every single transaction and put extra taxes and VAT taxes, or if someone said something the government didn't like, they could just shut off your bank account.
Yeah, again, I'm hoping that never comes to the United States of America.
I hope you're right. But I think there's people within the government, I don't know how many people, but I think there are some people who do want to see that. Ken Rogoff would be one.
Yes, but last time I checked, he is not in the government.
Yes, he just writes a bunch of papers that some of the academics inside the Federal Reserve read a lot of. Yes,
he does. But again, I am Jim Bianco is somebody who you should definitely interview if you have not yet. And he's written in recent weeks about a regime change among the world's central banks. And I am more hopeful than I've been in years that Jay Powell represents a distinct shift away from what we've come to know as business as usual.
So last question before I let you go. So if there is all this extra asset price volatility and there is problems in credit markets like you think there will be, and central banks do start to maybe actually reduce their balance sheets in a meaningful way, is this volatility going to actually be good for gold at some point?
Well, one would think. I mean, gold has been fairly range bound for a good bit of time. But, we for example, Facebook has recaptured its all-time high trading level. Until we see serious disruption, not just in the stock market, but much more importantly in the credit market, we won't see correlations line up the way they typically do, which precedes a rush into gold. But certainly upon the time of the next recession hitting, gold will once again regain its luster and be a safe haven for investors. Again, when correlations line up and there's no place to hide, there is always gold.
And do you think the stock market is slowly putting in a topping process? Because it seems that we've had a lot of volatility just in the last couple of months, 2% up, 2% down. At some point, the perma bulls that have been there for over a year now in stocks, because the stock market basically went parabolic in the last year or so since Trump won the election. At some point, if there is, back and forth volatility, people are going to get tired of it and sell out and go to cash, right?
Yes, at some point, and especially if interest rates keep rising, because it's not even a matter of pure frustration, but it is a matter of having some kind of logic. Because at some point, your cash becomes attractive enough to go ahead and you don't have to put your money under the mattress anymore. You can actually make a return on it.
And stocks do well, actually, for some interest rate increases, but if the interest rate increases keep going and going and going, at a certain point they break stocks, especially those leverage guys, because I think there's, according to either the Bank of International Settlements or the IMF, I forget which study, but 20% of all the corporations are zombie corporations, and they can't pay off any principal on their debt. They have to keep refinancing. So there's a lot of that's been going on. Austrians would call that misallocation of capital because of these artificially low interest rates.
Yes. I mean, and therein lies, you get to one of the better points, Jason. There are a lot of things that can be answered right now. Let's put it that way. But and I think one of the most frustrating aspects of how long we've been waiting for something to happen is that by the very virtue of us waiting for so long, it's going to prolong the wait.
Yeah, I mean, if you would have told me 10 years ago that the central banks would have expanded their balance sheets, the 5 or 6 major ones, they would have added over $20 trillion to their balance sheets since the 2008 financial crisis, and nothing would have blown up, the gold price would have been this low, I would have said no way.
But again, 2017 was a record level of QE. If you were only going to be following one metric, and that would have been global QE, then there would not have been any surprise at all.
That's a good point. And, I think, Danielle, a lot of people are complacent. So a lot of people on Wall Street are happy. They're making money off stocks and bonds. And a lot of people on Main Street who their home prices haven't crashed. Their 401ks have gone up a lot since 2008. So people like my dad, who's just, a regular investor, he checks his stock prices every morning and his home price hasn't crashed. They're pretty happy with things. They don't want to hear people like me and you telling them that there's credit bubbles and in the next couple of years there could be another financial crisis. They do not want to hear any warnings like that.
No, of course not. Because again, they're flush. They're back to being even. Their home price is up. Everything is up. Everything is good. And in a lot of cases also, the same people have not gone into debt, and so they're not as exposed. But the sad truth is the flip side of that is a lot of people who did lose their homes and whose credit was ravaged are the same people who have gained access to subprime car loans. And it's not that it's going to be some kind of an economic Armageddon moment, but the fact is a lot of the same individuals who made way for the Bernie Sanders, Donald Trump world that we live in, a lot of those same people who are still getting over the financial crisis are going to be hit all over again. And that carries deep socioeconomic implications with it that go so far beyond anything that we could talk about that had to do with the Federal Reserve.
That's a good point. Yeah, I remember reading in your book something you said that Richard Fisher told you about the pitchforks coming out. And he said that eventually the pitchforks would come out if the money printing was kept on and people would start to wake up and figure it out. But I think one of the things that was delayed by all this money printing by the central banks was that the pitchforks almost came out in 2008. We had Occupy Wall Street. The Tea Party went crazy in 2008.
Yeah, but they were all drinking $8 Starbucks lattes. It was something of a joke.
Well, I mean, people were even talking, the fact that people were even talking about the Federal Reserve and the bad stuff the banks had done was a huge improvement compared to the past. So, but I think a lot of that went away for a while after, the stock market started to go up. There's just not as many people who are frustrated or angry compared to like the heights of 2008.
No, that's true, but it wouldn't take a lot to get a lot. Look, you're looking at the wrong people who were angry at the Fed. I'm sorry, but the end the Fed contingency was something of a joke. You talk to me in a few years when you have pensioners pitted against people whose 401ks and IRAs have been ravaged. That is going to represent real anger.
Well, Danielle, you've given our listeners a lot to think about. I know I'm past my time here, so if our listeners want to follow more of your work and buy your book, how do they do so?
Hop on Amazon.com. Not to push Amazon, you can get it anywhere. Actually, it's now at Walmart and Target, so you can get it there as well. But get fed up, understand it, read it. It's very easy. It'll take you 48 hours, and you'll learn so much. I say that humbly. Follow me on Twitter at DiMartino Booth, and jump on my website. I write a weekly newsletter, and it's never boring. DiMartinoBooth.com.
Thanks again for your time, and keep up the great work. You do a great job writing your article. There's a lot of very dry financial content, and I think you do an excellent job putting in easier to understand terms and writing about things that the average everyday person who doesn't have a financial background like you or me can actually relate to.
Thank you very much. I take that as a high compliment, and you do good work for all of us as well in what you do every day, Jason.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.